Hello, my name is Rodolphe Vanderveken. I have just defended my PhD in Quantitative Finance here at the Louvain Finance Center within UCLouvain under the joint supervision of Professors Lassance and Frédéric Vrins. For the past 4 years, my research has been focused on a highly practical problem in finance, which is portfolio selection. So portfolio selection at its core, it's a very simple yet fundamental question. Imagine that you are an investor, you have a budget that you want to invest in a bunch of stocks, for instance. What is the best way of doing so? What is the best way to invest your budget into the different stocks that you have available? So portfolio selection, it's a practical problem that many of us face at some point, either directly when you want, for instance, to allocate some of your savings towards an investment, or indirectly, for instance, through mutual funds, pension plans or retirement products. So in both of these cases, research in portfolio selection plays a key role in guiding those investment decisions. My research in this context focuses on the impact of what we call parameter uncertainty on portfolio selection. But before looking at what parameter uncertainty really is, we first have to think about what matters for investors when designing their portfolios. Broadly speaking, investors typically seek to balance two key forces. First, maximizing the return on their investment, and second, minimizing the risk exposure. The objective is then to build a portfolio that is optimal in the sense that it's able to strike a trade-off between risk and return. So to determine this optimal portfolio, we obviously need some information about the underlying assets that we have in the portfolio. This information is encapsulated in what we call parameters. So for example, investors care about the expected returns of the assets in the portfolio, but also investors care about risk, so they will have to measure volatilities, correlations. These are also important parameters. So expected returns, volatilities, correlations are typically the critical parameters that we have in the portfolio selection process. Now, the problem that we have is that in practice, we do not know the value of those parameters with full certainty. We can make some guesses, we can perhaps estimate them from past data, but we will likely make some estimation errors in the process, and this might hurt portfolio performance. This challenge is known as parameter uncertainty, because we are uncertain about the values of the parameters in the future. Think about, for instance, the fact that it's very difficult to forecast the expected returns in the future for stocks. The question then becomes, how can I still be able to build an optimal portfolio given the fact that I'm exposed to parameter uncertainty? In my PhD, I explore 3 different yet complementary ways to deal with this problem. For instance, in my second paper, we find what is the optimal number of assets to invest in a portfolio so as to maximize the following trade-off. First, you have diversification benefits, which are beneficial to portfolio performance and which increase with the number of assets that you have in the portfolio because you are then able to diversify the risk more efficiently. But at the same time, you also have increased exposure to parameter uncertainty when you increase the number of assets because you make more and more estimation errors. We show that there is an optimal number of assets to hold in a portfolio which strikes this trade-off efficiently. And we also show that if you invest into that reduced number of assets compared to investing in all possible assets, you have significant performance gains. So out of the 3 papers that I have in my PhD, the first one is already published in the Journal of Business and Economic Statistics. The second one, which I was just mentioning before, is currently under revision, and the third one is in the working paper stage. And in the coming months, I plan on finishing the publication process for all of my papers. Thank you for watching.